Nilesh Shah joins us, Managing Director and CEO with Envision Capital. Nilesh, fantastic to have you back. Thank you for joining us. The question which I'm asking everyone is that, is this the darkest dusk before the dawn, or we are in for a long winter?
Well, it's dark and there's surely a dawn ahead. The question is how long it's going to kind of get. But I think the way we are seeing is that I think a lot of the damage is already done.
Price damage or economic damage?
I think price damage is kind of by and large done substantially. There could still be some more damage. I mean, that you can never figure out really where precisely is the bottom. But I think by and large, a lot of the damage is done. Sentiment is completely down. The demand outlook in general, I don't think has been so weak for many, many years. So I don't think it can get significantly worse from here.
Why do you say that? Because if demand has gone down, it's like wheels are connected with wheels and connection with wheels. If one end of the wheel stops, it could have an impact on the entire supply chain. What we've observed and learned by watching markets over the years, Nilesh, is that little bit of disruption in supply chain could have an impact on steel demand, cement demand, construction demand. Are we headed there?
Which I think is already happening. It's not that that's yet to happen. The dislocation or the suspension of demand, I think, is already kind of happened. I clearly believe that, don't fight the Fed. So I think now clearly the ball is entirely in the government's court. And if the government really kind of gets aggressive in terms of measures, initiatives, reforms, which you can never figure out when it's going to happen, what is going to happen, I think it can have a huge positive impact. And that's obviously the need of the hour. And I think if the government really kind of steps in, it's something where the sentiment can turn overnight, and basically we can be back to kind of a very strong demand environment.
What do people do in the meanwhile, Nilesh? As you said, sentiment is so weak right now. There's no conviction. And everyone's been crying out for the government to do something, particularly on the fiscal side, a big push on spending. But we're not seeing that. It doesn't look like that's going to happen.
Yeah, I mean, so far, yes. I think whatever stimulus has come in mainly in the form of rate cuts. Sure. And to some extent, some very few cherry-picked sectoral initiatives like what happened on exports or real estate or auto. But I think what is really required is on a very aggregate basis that how do you fire up the animal spirits of investors, consumers and entrepreneurs. These are the three large constituents of the economy. And how do you do that? And I think for that, I don't think just a very simple sectoral approach will work entirely. It will have an impact, but a very limited impact. What is required is something which is really on a very massive scale, all-encompassing. That is the kind of stuff which is required in an environment like this.
So Nilesh, it's not that you've not heard anything from the government. We are hearing we are getting not a weekly press conference, but a daily press conference, and there are two conferences from the finance minister. Whatever we've heard, some would argue that, look, there's nothing new, there's nothing grand. These are extraordinary circumstances. By starting something like a loan mela or giving credit back to the exporters, that's not going to fix a $2 trillion economy. Is the government running out of options, A? B, and do you think markets should get realistic that government, even though they have the willingness, they don't have the ability to do it because there are too many arrows are not actually left in the quiver now?
No, in fact, there are plenty of arrows left. Okay, the government has plenty of bullets to fire. Okay, it's just a question of basically pulling the trigger. And I think clearly, if you look at it, I think on the fiscal side, for example, just do away with this LTCG tax. Not required at all. Even for the next 2, 3, 4 years, the way the current environment, if it remains or prolongs, you're not going to have massive mobilization from that, number one. Number two, remove these multiple levels of taxation, which is this dividend distribution tax, tax on buybacks. Just do away with all of this, okay? Because what is happening is by having these kind of taxes, the companies are holding back the cash rather than distributing that capital away, okay? So that's two. Third is go on a massive privatization spree. There is plenty of political capital. And I think that needs to be, invested right now in going wholesale privatization. Just go back to the years of 1998 to 2003 and just replicate what the government did then. And I think if they do it like this, my sense is, our view is that basically the animal spirits will be ignited. And third, of course, is use that money to basically invest into infrastructure. That's what it essentially should be doing. Yes, some of the measures already announced will have a positive impact. But it's not something which will probably propel us from 5% growth rate to 8% growth rate or 9% growth rate. This will, yes, probably stem the decline. It will arrest the decline. 5% will go back to 6 or 6.5%. But we've got to go to 8 and 9%. And I think for that, some wholesale measures like that are required. ease of doing businesses alone is not good enough. It will have to be broken up into ease of manufacturing, ease of mining, ease of trading, ease of exports, ease of farming. A whole kind of a very silo approach will also have to be adopted. So you need something which is really big bang, mega at the very macro level, followed by a very silo approach. I think that is what is required, and I think the government has plenty of arrows to really shoot and fire. And I think that is probably the approach which is required right now.
And I hope they choose to do that. The finance minister has 2 press conferences today, not just one. I hope some of these measures are announced. What happened to your hand though, Nilesh?
Well, just a fracture, the way, the way markets are fractured, collateral damage.
Clearly. But tell me, I mean, it's easier said than done, buy the fear. But is it time to buy this fear now?
Oh, absolutely, undoubtedly. I think the times when everybody is fearful, that's really a good time to basically invest, put money to work. That's how basically over the medium to long term returns will be made. Because I think prices have become reasonable, okay? And I don't think fundamentals are going to remain like this forever. Fundamentals will turn at some point of time. Demand will come back. As we discussed, the government has a lot of ammunition left to fire. So basically, I think all in all, honestly tough to pinpoint when the fundamentals will turn. Will it take a quarter? Will it take a year? It's hard to figure out. But I think the reality is that we are enjoying a lot of tailwinds. I mean, interest rates are down, commodity prices are kind of in a way settled. Yes, there are a few spikes here and there, but by and large they are settled. The global liquidity environment still is very benign. So all of these are tailwinds. Now I think is that the prices have become reasonable for a lot of stocks in a lot of sectors, and I think that is where the opportunity lies.
So where do you hunt? Yeah, exactly.
Same questions. You can say no to me, but you can't say no to Asha when it comes to stock specific.
No, so I think, for example, just look at the financial services space, and the credit space has played out. The banking space, etc., all of that. But I think within that, insurance is there.
When you say just for the
but insurance stocks are not cheap, Nilesh.
No, they are not cheap, but they have still a solid growth opportunity. I think the way banks were, I mean, some of the banks were never cheap, okay? But it's just that the intrinsic value of these banks kept increasing year on year because of the demand environment. So similarly, I think some of these insurance companies as well as some of the AMCs are at that particular stage where the banks were maybe 10 or 20 years back. So you have an opportunity for the next 10, 20 years of growth for some of them. Now, it's not necessarily that you go and buy them today, but you go and buy them at a price where you believe they're attractive and you be invested in them for the long term. Some of the consumer appliances names, they have fallen. Some of the discretionary spending areas, things to do with travel, tourism, etc., hospitality, they have fallen in this environment. I think that's a great opportunity to go and buy into them. So I think there are pockets of growth which are still there, and where you need to basically go out there and buy.
But Nilesh, central theme is still consumer, right? Now,
I think
that's where slowdown is.
It is, yes, but it's not that people are going to permanently stop holidaying. That's not going to happen. It's not that people are going to permanently or never ever going to buy consumer appliances. That's not going to happen. You will see these things come back at some point of time when consumers feel positive about their own outlook going forward. When they believe that yes, the incomes are going to keep rising and all of that. That is when a lot of the discretionary spend comes back. I think similarly in terms of homes, I think it's a brilliant time to buy affordable homes. Now that's a great category to kind of be in, where stock prices are down and there are still a few quality names out there. Go and buy into them.
What about auto then? Where does auto
I think within auto, passenger cars are a complete avoid. Complete avoid. I don't think they should be looked at all. See, if you look at it, some of the most developed markets, nobody talks about the Ford stock price. Nobody talks about the General Motors stock price. It's only in India that we are so obsessed with these car names and passenger car names. But I think there are huge challenges there. And that's unlikely to change. Okay. That's unlikely to change very soon. Yes, you could have 5-10% moves in stock prices. But I think beyond that, I think that no longer is a great structural opportunity. I think versus that, I think probably two-wheelers and the CVs are a relatively better space.
You're not worried about the disruption of electric two-wheelers? Because that's something Rajiv Bajaj keeps on alluding to. That's coming.
Yeah, but I think the incumbents again are equally focused on that. It's not that they don't have the wherewithal. See, I think electric two-wheelers is essentially no great technology play. It's a very, very simple technology. Yeah. There will be some kind of enthusiasm or talk about it for a quarter or two, saying, look, this is the latest electric two-wheeler in town. But I think after that, it will all boil down to distribution, that who has a pan-India distribution. And that's where a new player will find it very difficult to build. Whereas the existing guys who have the financial resources, who have the technology prowess to kind of introduce an electric two-wheeler, and on top of that, they have the distribution reach to reach every small town of India. And that, I think, is going to be the differentiator.
Nilesh, so the current market, all of us know that markets, they follow a pattern, they follow a cycle. There is a boom, there is a bust, there is an opportunity, there is fear, and there is greed. According to valuations are strong and the risk is favorable. So that's one part. Second part is, let's understand the regime. The current environment, does this remind you of 2013 where mid and small cap stocks, they were available very cheap and then we saw 2-3 year mega bull run? Or the current environment reminds you of what happened after demonetization? We were picking the same sound bites after demonetization. Consumption will slow down, consumer stocks will come down, there is cash in the economy. But look at what happened after demonetization. The consumer demand and everything has come back. I mean, imagine, Aisha, we are sitting in the same studio, all of us, and we would say, oh, demonetization ho gaya, consumer is over. Whereas cash economy is dead. People will not buy cars, land will not be sold. But nothing of that happened. Are we going through that?
Unless what is playing out right now is a lag effect.
Exactly. So I don't know. I'm just trying to understand where are we right now.
Yeah, I think probably this slowdown, I still think, is very different from the earlier slowdowns that we had. I think if you look at India, I think the investment cycle never picked up for maybe even a decade. Okay. So we were in a way trying to run a single-legged race of the consumer side of it. Now on the consumer side, probably that's kind of run some steam. It's kind of in a way saying, yes, it's still, it's not that the demand is completely out, but it's kind of not enough to kind of keep us at that 7-8% growth rate. And therefore we've slipped to a 5% growth rate. Okay. So I think it's a bit different from the earlier scenarios. I think it's very, very important. And if you kind of just try and stimulate consumer demand, it will probably benefit China more, Vietnam more, Bangladesh more, rather than India. So I think it's time to really focus on the investment side, saying how do we kickstart the investment cycle? That's very, very important. And I think that is probably the need of the hour.
Nilesh, what could challenge your assumption on the market? The fact that you have that conviction, you are that eternal optimistic, and you believe that the market can be bought and these select few segments look nice. What would you make you say that, you know what, no, not now?
I think, of course, if globally, I'm just saying is if globally, if the slowdown converts into a recession, I think that's probably one important risk. And I'm not entirely sure if we are really well geared for that. And I think it's an important source of volatility or important source of risk. And I think we have to somehow gear up to face that environment or gear up to meet that kind of a challenge. And I think to do that, you will have to undertake the kind of measures which I alluded to earlier in terms of really the very big bang fiscal benefits and withdrawing of some of those taxes and all of that and wholesale privatization. I think that's the only way you can kind of try and, in a way, gear up or meet that challenge. So to meet that, I think is a very, very important kind of a risk factor. The rest, I think, I'm not so worried about the everything else because I think rural demand, I think, is well poised. We've had a favorable monsoon. So I think hopefully rural demand has seen the lows that we've seen over the last versus what we've seen over the last few years. So I'm not so worried about that. But I think the big area of worry could be that if the current slowdown translates into any kind of a significant or a long drawn slowdown or even some bit of a recession, then I think, that would be a very strong source of worry.
True. And one often wonders as to where the selling is coming from. And I'm just taking an example from just yesterday, as recent as that. The FI, the DI, sell and buy figure was equal, almost thereabouts. And then you wonder, if that's the case, that one bought in the same quantum and one sold in the same quantum, that should have supported the market. Then why that 200-point fall? I mean, are you seeing the HNIs and the retail participants now completely redeeming out?
So, I think that remains an enigma, that despite, the plus and the minus adding, it should have been a zero-sum game.
True.
So that remains an enigma.
The balance sheet should have tallied.
Absolutely. So I honestly don't have an answer. But yes, what can happen is that I think the reality is that the FPIs are selling, okay, and the DIIs are buying. But what it looks like is that the FPIs are significantly overweight on the banking space versus the DIIs. And I think clearly the pressure is in the banking space. The banking space as a weight in the Nifty is disproportionately large. And I think again, probably the FPIs are taking a view that the best is over in terms of the banking space, or that they are overweight, they need to be market weight, or they need to be underweight. So that I think is selling out there. Whereas the DIIs might be buying other pockets and not necessarily the banking space alone. So I think that is probably what is happening out there.
And Nilesh, when you say buy insurance, buy consumer durables, if I can just break it for our viewers, not for a sophisticated investor like you, the comparisons which I've been given is that, okay, insurance is a great long-term picture, but if you're buying insurance stock, it is like saying you're buying HUL at a P multiple of 100. Is that true? I don't understand how to value insurance, so I'm asking a basic question.
Yeah. So I think if you look at insurance, there is life insurance and there's general insurance. We see life insurance stocks to be more expensive versus the general insurance stocks. Okay. So to that extent, between the two, we are more inclined towards the general insurance space rather than the life insurance space. Yeah. So I think that is number one. Number two is that life insurance can be very lumpy. Number one. And number two is you've really got to take a call on the ability of the insurance company to write these insurance policies for the next 10, 15, 20, 25 years. Okay. So what you do today, the mistakes will come out maybe many years later. It's like what you do in a bull market will appear to be good or bad only in a bear market. So similarly, something is true for the life insurance spaces. Whereas in general insurance, it's like buying an FMCG product. Every year you kind of insure your car. At the end of the year, you have to renew your policy and pay another premium. So to that extent, it's far more recurring, far more stable, far more predictable, and pretty much like the FMCG space. So you're right that yes, valuations are high, but I think these are companies where the ROEs are high, growth rates are high. So no matter what we say, HUL, yes, of course, it looks overpriced, overvalued, and all of that. But it has never gone below, it has never gone down to say 20, 30 P multiples. It has always remained at a particular level because there is high visibility in these kind of business. And I think that's true for the insurance space as
Before
well.
we wrap, Nilesh, again, Asha, this is something what I've learned in the last couple of years is that as investors, the hunt is always to find that next multi-bagger, buy something which can be 5x, 10x, 15x. And as a result, we tend to ignore some classic compounders. Asian Paints was always expensive. HDFC Bank was always expensive. But these are discovered well-named compounders which people tend to ignore. And that's what fund managers like you say, look, we'll not buy the obvious, we'll buy the inobvious. But do you think that strategy should change in this kind of a market? Buy the obvious names.
Maybe it's true in this environment. But see, I think you have to keep in mind that why are these classic compounders doing well right now? And doing well means that they're not delivering you mega returns. It's just that
you're not losing money.
Exactly, agreed. And this will continue till rest of the economy remains stressed. The day the rest of the economy starts firing, you will see this pack underperform significantly. This is precisely what happened between 2003 and 2008. That when the investment cycle did extremely well, you saw a lot of the other segments, a lot of the other sectors do well. So right now, this is just a flight to quality. It's like you have a fixed income market, there are government securities, and then there are corporate bonds. In corporate bonds, you perceive a risk of default, for example. So you tend to put all your money into government securities. The day risk on happens, money moves back into corporate bonds. And this is precisely what is happening, that those 8, 10 names, all the money is just gushing in there in the name of compounding. The reality is that mean reversions also apply there. So these 60, 70, 80 P multiples can pretty much go down to 30, 40 P multiples. And you'll have a scenario where for 5 years, other sectors probably double for you, whereas these stocks don't go anywhere. And that's, of course, it's something which has been happening, but I'm not sure whether this will continue till eternity.
I will use my executive powers to ask one more question. I know my producers will yell at me. My last follow-up question is that let's work with a slightly shaky kind of a scenario. The shaky scenario is that what if the investment cycle does not pick up? What if the consumption cycle does not pick up the way we are proposing? What happens to market then? Because investment cycle was supposed to pick up not this year, 3 years ago. Investment consumption cycle was not supposed to slow down this year. It has slowed down. We are staring at what we were not prepared for. We are prepared for a pickup in consumption and investment. What if the delay is 2-3 years? I don't know. What I don't know, I can't comment on it. What do you do as an investor?
Yeah, so I think if that really happens, I think again you will have to be in these pockets of safety, pockets of quality, pockets of visibility. I think that as a pocket will continue to do well as long as nothing else really happens.
So you invest in HDFC Bank, a Bajaj Finance, but don't go all in, is what you're saying?
Yeah, absolutely. I mean, within that also, I think you can. There's enough to pick and choose, and probably be in that. But I think the way we thought that 3 years back or whatever it is that all these cycles will continue. Today, we are probably all willing to believe that this cycle can continue for a far longer period of time. I'm just saying is maybe it's time to be contrarian. Don't underestimate in terms of what regulators and what the government can do. And I'm saying is that maybe 3 years back, we probably saw that nothing is really happening. I think today, my view is that a lot will happen. And I'm not willing to believe that the consumer cycle is permanently impaired or the investment cycle is permanently impaired and it will never pick up. I think probably my view is that probably in the next 1 or 2 quarters, I wouldn't be surprised if there's a lot of action from the government.
Oh, we hope so. Nilesh, thank you so much for joining us.
Thank you.
Chatting with you this morning. Okay, that was a view coming in from Nilesh, and still hopeful that we will see some significant announcements from the government.